This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 251, after a great episode last week with Professor Campbell. But this week is another great one. So I think by popular demand, Ben, you're going to dig into covered calls.
You know, this is one that just never died. People have been asking me to cover covered calls for, like, I don't even know how long, since I started doing my YouTube videos. And it was like here and there I'd get requests for it. It wasn't like everybody asking all at once, but it's been one of the most persistently requested, even if not the most frequently requested concepts to cover. So I've finally caved and spent a bunch of time reading about it, and I hopefully have some interesting commentary.
And then, much like we did a few weeks ago with Jonathan Clements, we're going to do a review of past guest Robin Powell. He was guest on episode 27, but he, along with his co-author Jonathan Hollow, just released a great book called How to Fund the Life You Want, What Everyone Needs to Know About Savings, Pensions, and Investments. So we'll look back on our interview with Robin a few years ago. Then those guys will join us after we do a quick book review. Phenomenal book, by the way. And then, of course, we'll do the after show for the three people that stick around.
There should be a shirt for that in the store. I don't know what it says, but that's a running joke. The last three people.
That is true. So earlier this year, Ben, you and I started kind of promoting, I guess, our practice. And since we've done that, we've had a bunch of people reach out to the team, which is fantastic. And it's great to meet Canadians who might want some help with their financial decision making. We have a phenomenal team of a dozen or so highly skilled people. So if you're looking for some help and you're Canadian with your financial decision making, please do reach out. Anything to add, Ben?
Well, no, I was just going to say that's been interesting. I think we've always been a little shy or hesitant about promoting our business, but since we've been doing it, the number of people getting in touch to talk to us about becoming clients has like increased pretty significantly. So it's I don't know what's contained there. What information is in there? I guess that we just weren't talking about it enough, and that there are people out there who could use a service like the one that we provide, but maybe just needed a prompt, or maybe didn't know what we did. I don't know.
Yeah. So reach out. We're easy to find. Okay, with that, let's get to the episode. All right, welcome to episode 251, with the main topic being covered calls. I'll do my best to make sure we go through this slowly and understandably, as I try to do, but this one is particularly, I don't know the word's complicated, but I guess it is complicated. And anyways, I'll let you get going, and I'll do my best to help.
It is complicated, and this is not part of my main coverage of this topic, but just as some commentary to start, one of the things we talked about in a recent episode was the complexity of financial products. And there's some really interesting empirical research on how more complex products tend to perform worse and have higher costs for investors. And we also talked about the concept of shrouding, how complexity can shroud high costs, where consumers end up paying costs they don't realize. Like even fee-conscious consumers might end up paying high costs because the costs are hidden. I don't know, just an interesting preface to think about as we dive into this. But it is a complex topic when we start getting into options and payoffs and how all that stuff works. And I did get input on these notes from a few people who know a lot about this stuff, including some of the co-authors of one of the papers that we referenced in the notes. I also talked to Patrick Boyle, who people may recognize from his YouTube channel. He's got a very large YouTube channel. He wrote a textbook on options, and I know him sort of casually. So I sent him a note just saying, hey, can you look at this? And he thought it all looked pretty good. Anyway, so I did try to get a whole bunch of input from people who know what they're talking about. VinViz in the Rational Reminder community. People know him by his username. I also chatted with him about it. Anyway, So lots of input. Okay, I'm rambling on. We'll dive into it. Okay, so covered call strategies, which are sometimes referred to as buy right strategies, are often sold as producing high income yields and generating equity-like returns with less risk. But these claims, as you may have guessed, they fall apart under scrutiny, which is exactly what we're going to apply here. The target yields on these products are often above 10%, sometimes way above 10%. And those yields are often advertised in promotional documents and on fund websites and stuff like that. You also see statements like enhances current income and lowers volatility and downside risk.
Sounds good.
Those are the claims we're going to dive right into. It's going to be a lot of fun.
Mm-hmm.
Now, it's important to remember, and this is something that VinViz from our community reminded me about. I hadn't thought about this statement in a very long time. But we got to remember that risk cannot be destroyed. It can only be transformed or transferred.
What a line.
Now that comes from that comes from physics. It's a play on the law of conservation of energy, which says that energy can neither be created nor destroyed. It can only be transformed or transferred from one form to another. But risk is similar. You can't make it go away. You can just transform it or transfer it to somebody else with a financial contract. So I think that's a nice way to start thinking about this, because you cannot make risk go away. You can give it to somebody else. In this case, when you're selling calls to somebody else, you're actually you're the one taking the risk. Anyway, covered call strategies don't generate income in the way that investors imagine. Now, that's a big one. Talked about 10% yields. That's not really income. And I'll explain what I mean in a second. And they're risk-adjusted returns. That's one of the other big things, right? Is you expect to get, or the pitch is, you might get a little bit lower total return than equities, but with much less risk, or with less risk, in such a way that your risk-adjusted returns, typically measured by something like the Sharpe ratio or the Sortino ratio, are going to be much more attractive. Now, one of the things that I'm going to argue is that is only true when risk is improperly measured. When you use an incorrect measure of risk, it is true that the risk-adjusted returns of covered call strategies can be very attractive, but that's due to an error in measurement, not due to a reduction in risk.
Wow. Okay.
Yeah. These strategies are also generally going to be tax inefficient and more expensive to own in terms of fees and costs than simply investing in the underlying assets.
That's a pretty good setup.
Yeah, so that's the setup. Now go a little bit into what the assets involved here are. So a call option is a financial contract that gives the buyer the right to purchase a security at a set price.
Check.
When a call option is in the money, it can be sold before maturity or exercised to purchase the underlying security below its market price from the option seller. Covered call strategies own securities. So you own the underlying stocks or assets in the index or whatever, and then you sell options on the same security. So you own it, you own the security, and then you sell an option on a call option on the security. So say it owns the S&P 500, then you sell call options on the S&P 500. And it's called covered because the underlying security is owned when the option is sold. A naked call would just mean selling the option without owning the security. And then in that case, you have unlimited downside with a naked call because a security price can go up infinitely, theoretically, unlike a covered call, which can have negative returns only to this point that the underlying security goes to zero. Because if it goes up, you're hedged by owning the security.
Right.
Yeah. Due to put-call parity, a covered call and a short put have the same payoff. I got that from Patrick Boyle. It's kind of hard to think about. Options are confusing, but if you look at the payoff diagrams for the two strategies, it's very clear that they're the same. That's more just a point of interest. Okay, now selling call options does generate income through option premiums. And that's one of the things a lot of investors find attractive. But it also puts a cap on the upside of the underlying securities while only slightly improving downside risk. But when you sell a covered call, you're selling the right to purchase the underlying asset that you already own at a specified price. If the call expires without being exercised, you earn the return on the underlying assets plus the call premium.
Exactly.
If the buyer of the call option exercises, the underlying securities have to be sold below their market value.
Right.
Now, covered call strategies are typically going to demonstrate those high distribution yields that I talked about earlier, which seem attractive to income-oriented investors, but the yields are misleading, and this is one of the really important points. When an option is sold, the seller receives income from the option premium, and they have a potential liability in the event that they need to sell the underlying shares below market value to the option buyer in the event of an exercise. The fact that the option premium is distributed as an income yield, like that 10% yield that I mentioned earlier, that's super confusing to investors, and we know about mental accounting being problematic and the whole concept of income investing and dividend versus capital and all that kind of stuff. What selling covered calls is doing is it's generating current income from the option premiums at the risk of foregoing future capital returns due to foregone appreciation in the underlying security.
Precisely.
Right. So on a net basis, when you think about total return on a net basis, we would not expect covered call strategies to have higher risk-adjusted returns than their underlying assets. That's important on its own, unless options are overpriced. So that statement, I have three references for that statement from one's from an old paper by Fisher Black, one's from Robert Merton, and one's from a paper by a guy named Rentelman. But this is not like it's not a controversial thing to say. That you would not expect higher risk-adjusted returns unless options are overpriced. But that makes the income yield figure somewhere between irrelevant and overstated. Not completely irrelevant. That's not fair. You know what? It could be relevant to a behavioral investor. And one of the things I'll talk about later is that to the extent that income and capital separation can be used as a tool to modify investor behavior, maybe it's not totally irrelevant. But at least from a rational, non-behavioral perspective, it is completely irrelevant.
How important is the line unless options are overpriced?
Okay, Cameron asks, how important is the line unless options are overpriced? And I'm retaking my answer to that question to match my notes because my original answer, Cameron just kind of caught me off guard. The total return of a covered call strategy can be decomposed into a reduced equity beta relative to the underlying and a volatility risk premium, which exists if options are overpriced. So writing options slightly decreases exposure to the underlying equity while eliminating exposure to large positive moves. And we'll talk about the effects of that shift in the distribution as we move on to the next section. This is important, though, because if you want a lower beta to an asset, you could reduce your exposure to the asset. But systematically selling options primarily makes sense as a strategy to pursue that volatility risk premium, that option mispricing, but not as an income strategy. So that pricing piece matters because of that, because this strategy is interesting if options are mispriced, but much less so if they are properly priced. Okay, so let's jump into the lower risk idea here. So covered calls are often sold as having equity-like returns with less risk. That's one of the big selling points. But we have to dive into the measure of risk, which matters a lot in making that judgment. The challenge is that options affect higher moments of the distribution. including skewness and kurtosis being the big ones. A common measure of risk-adjusted returns, like the Sharpe ratio, which most people are familiar with, that's the ratio of an asset's excess return over the standard deviation of the excess return. That's going to be inadequate for assessing the performance of strategies that have options, generally, due to the effect of the effect of options on the normality of the distribution. The Sharpe ratio follows the logic in Harry Markowitz' mean variance framework, which assumes that the mean and the standard deviation of single period returns are sufficient for evaluating the relative attractiveness of investment portfolios. Now, if you imagine a normal distribution, which is well described by its mean and standard deviation, the distribution of outcomes is going to be symmetrical about the mean. Now, when you write call options, you're going to slightly improve the left tail, the bad outcomes, by the amount of the option premium. And I mean, that's another interesting point, is that these are often sold as having downside protection, but you're getting an option premium, which slightly improves your downside, but you're not getting any kind of hedge. Because if the underlying drops, you're still fully eating the decline minus your option premium. So writing call options slightly improves the left tail by the amount of the option premium, but it completely cuts off the right tail above the strike price. So you do get a lower standard deviation, but you also get much more skewness. Now, if you think about that, you're completely cutting off one tail of the distribution, lowering your standard deviation, measuring the risk-adjusted returns of that strategy with something that only takes the first two moments, the mean and the standard deviation, into account. Of course, it's going to make it look better.
Fascinating.
Right. So there are other performance measures like the Sortino ratio, which replaces the standard deviation in the Sharpe ratio with downside risk relative to a benchmark. That's also going to be inadequate, again, due to the shape of the distribution, because we're really affecting that right tail, and the Sortino ratio is not worried about that. There's another metric devised by Frank Sortino, who came up with the Sortino ratio. He devised one called the upside potential ratio, and that replaces the excess return over the risk-free rate, like you have in the Sharpe ratio, with the excess return over a benchmark. Now that ratio is more successful in assessing strategies with skewed distributions. So we're measuring, in this case, the expected return above a benchmark over the level of downside risk, rather than the mean above the risk-free rate over the level of volatility, as with the Sharpe ratio. When you use that lens, the upside potential ratio lens, to look at covered call strategies, they're typically going to underperform the underlying index even before fees and costs and taxes are considered.
Wow.
Now, I mean, it's not like the perfect measure or anything like that, but it is a measure that has been shown to work with more skewed distributions, and when you flip the lens to that ratio, these strategies don't look so good. Which, I mean, it just makes sense because of how important the right tail of the distribution is for stock returns. Like, we know that empirically. The best months or whatever are really important to your total return. If you cap them, it makes sense. It wouldn't have a very good effect. And when you measure using a ratio that takes that into account, it just makes sense that it wouldn't look so good anymore. Now, Markowitz theory suggests that rational investors are going to weigh single period mean against variance in making asset allocation decisions, and it implicitly assumes that mean and variance describe the distribution of returns. And in that case, the Sharpe ratio is useful. But if investors care about weighing returns above a benchmark, above returns below a benchmark, and returns are not normally distributed, then the upside potential ratio is going to be more useful. And I think that better describes what most people are trying to do with covered call strategies. Well, maybe they don't realize what they're trying to do, but mean and variance aren't the only things that matter in assessing risk, I think, is the main takeaway there. And when you account for that, the attractiveness of these strategies changes pretty materially. But there's no perfect model for assessing risk-adjusted returns. It's ultimately going to come down to defining the user, the person investing in the strategy's utility function, which does mean that for some investors, covered call strategies could make sense. It's one of the hard things with investing, right? Is like, what are you trying to maximize? One of the things I've heard Fama say, I can't tell you what the optimal portfolio is unless you tell me what your utility function looks like.
Exactly.
So even if we decide what the rational model is for assessing these strategies, and that model suggests that they're suboptimal, it can still be useful for prospect theory investors who are very risk averse for small losses, but will take on investments with a small chance of very large losses, and investors who rely on mental accounting to determine their spending and who want to spend aggressively from their portfolio. An investor described by those behavioral characteristics, maybe this is a great strategy for them. And there's a paper from Hirsch Sheffrin, who we've had on the podcast, actually co-authored with Meir Statman, who we hope to have on the podcast or will have on the podcast.
Mm-hmm.
They've got a paper on this, on looking at covered call strategies through this behavioral lens, and then kind of say like it's not so crazy when you consider these behavioral characteristics of investors, even if it is otherwise a suboptimal strategy.
That's also the kind of thing we talked about with upcoming guest David Blanchett.
Totally. Yeah. There are all kinds of investor preferences and characteristics that you can try and model that can make any strategy look good given those investor characteristics and preferences. And there's no correct model to say everyone should invest this way. Now, all that said, if the objective is outperforming a benchmark or some benchmark level of return, covered calls probably are suboptimal. Now, another approach of assessing the optimality of covered call strategies and the existence of a volatility risk premium is just controlling for the skewness in their return distributions using a couple of different control techniques that a paper that I found did. And when you do that, when you control for that, any perceived superiority in risk-adjusted performance disappears. So another way of saying that, and what this paper I'm talking about concludes, is that the abnormal performance of covered call writing is largely driven by the disregard of skewness in the measurement of its performance.
Wow.
Yeah. So the information on the shape of the distribution, limiting the usefulness of standard performance metrics when options are in play, this has been known in academia for a long time. I remember Cam Harvey told a story about this when he was on our podcast. It's been known in academia for a long time. But in practice, like you look at any fund webpage and you see the Sharpe ratio still for any strategy. Maybe the Sortino ratio. Yeah. And it's a thing where whether they realize they're doing it or not, investment managers can effectively game the system. They can game the performance metrics by using things like options and other complex strategies that will make the Sharpe ratio sort of artificially but mechanically inflate. So if you know investors are going to look at that as a metric, then you can kind of market the fact that you have attractive risk-adjusted returns if you know people are using the Sharpe ratio to assess risk-adjusted returns. Now that gaming, and there's a paper from Will Getzman actually on this, that gaming works even in the face of high costs, extremely high costs, which can be relevant for this covered call strategy that we're talking about specifically. Now Getzman, in that paper, they did actually devise a manipulation-proof performance measure specifically to get around these issues. It's a little more complicated than the upside potential ratio we talked about earlier. But one of the papers that I'll mention in a bit, they actually use that manipulation-proof performance measure and again show that these types of strategies that use option writing to generate income are suboptimal. Okay, so I've alluded to fees and costs and taxes a couple times. These are major considerations for this type of strategy. When you look at XYLD, for example, which is a U.S. S&P 500 covered call ETF using Morningstar's tax cost ratio methodology for estimating the tax efficiency. You can think about this sort of like an MER that you pay in taxes. XYLD has a tax cost ratio for the trailing 5 years of 3.49% compared to 0.65% for SPY, which is just a S&P 500 index fund. So big difference. In Canada, it's a little different because the option premium income is going to be taxed as capital gains, and in the U.S., I think it's going to be taxed as short-term capital gains, which is less tax efficient. So maybe not quite as bad in Canada, but you're still getting pretty significant capital gain distribution yields in Canada. So of course, that is an additional liability for taxable investors to overcome. And it's important to remember that you're paying tax on that income, but it's not income in the sense that an interest payment or a dividend is income. It's income that comes with an embedded liability that empirically we know actually reduces your total return. So you've got this big tax hit combined with a lower total expected return. Not the best. And it's due to foregone gains in the event that the underlying appreciates. They also are going to tend to have higher fees, products implementing these strategies. If you look at, again, XYLD, it's got a MER of 60 basis points. If you look at Canadian products doing covered calls, they're often similar fee range or maybe a little bit more expensive. And of course, we're benchmarking that against, 25 basis points for VGRO or like 3 basis points for VOO.
Right.
So you're paying a lot more in costs. Now, those costs also don't include implicit costs like bid-ask spreads, which just from more transactions, you're going to probably have higher implicit implementation costs as well. Now, if you take a step back, so I mentioned a couple just random examples of ETFs, but if you take a step back and look at the broad sample of mutual funds, live mutual funds using covered calls and covered puts in this sample to generate income tend to underperform, but measured both by their excess return and by that manipulation-proof measure that we mentioned earlier from Will Getzman's paper. Now, on that point, for completeness, I do want to mention that DIY investors implementing this strategy aren't going to pay those higher fund costs. But there's also research showing that individual retail investors trading options pay like 12% spreads.
Oh, wow.
So, and they lose money on average. So while it may be true to say that, yes, theoretically you could do this at a lower cost by implementing it yourself, you might give up any gains in higher transaction costs than an institution might get. Now it is true that in a flat market, covered call strategies will outperform, because in that case, you're collecting the option premium and it's not being offset by foregone appreciation in the underlying securities. So if you believe that the market or a segment of the market is going to be flat or slightly negative, in that case, covered calls could be interesting. But of course, timing the market is hard at best, and you can't predict a flat market. And cutting off that right tail of returns is, it's not great, because we know how important the right tail is to total stock returns, especially in the long run. It's those we've seen those stats on, if you miss the best month of returns, how much lower your total returns, the same kind of idea. So covered calls are sold as high income strategies with attractive risk adjusted returns. Under the hood, and when you use the appropriate lenses to assess them and their risk adjusted returns, they're neither high income nor do they have attractive risk adjusted returns, and especially net of fees and taxes. Empirically, when you look at funds that have been around for a while implementing these strategies, they've typically trailed a plain vanilla fund of the same asset class by a very wide margin, while having a higher Sharpe ratio. So that's the thing, right? Is that some people will look at, okay, it's trailed by 3% a year, but look at that Sharpe ratio. But as we've hopefully articulated, that's more driven by measurement error than actual reduced risk or increased risk adjusted returns.
That's it?
That's it.
Okay, good listener, good viewer. How good was that? That was clean, understandable, concise, gold, in my opinion.
Glad you think so.
And I'm sure that will be used by many of our fellow advisors, our good friends in the community, to share with people when they ask that question.
I hope so. I'll make this into the shorter CSI videos too.
Yeah. Excellent work. Okay, you good to move on?
Yep.
Okay, so let's do one episode in 60 seconds, but I want to give a backstory on this. So the point of these is for regular listeners who may not have been around back in the earlier days to help choose an episode to go back and listen to. And we welcomed Robin Powell 4 years ago, Ben, if you can believe it. And he was one of the higher profile guests that we had early on. I think he was, kind of that interview has convinced us to go to this every other week with a guest episode. So I thought it'd be a good idea to highlight this. Robin is an award-winning journalist and a self-described campaigner for positive change in investing. He previously worked in broadcast news in the UK and was also in current affairs. He was a news reporter and documentary maker for ITV for 14 years before joining organizations like Sky News and BBC. He's also the founder and editor of the Evidence-Based Investor, which is a news and content syndication service. He's also the editor of Advisor 2.0, which you can find at advicereinvented.com, which is a blog exploring changes in our sector, Ben, the financial advice sector. He's also the founder of Ember Regis Group and subsidiaries Regis Media, which provides content to financial advisory firms, and also Ember Television, which produces and distributes video content about our industry. So he's a well-regarded individual. He's got a great background and incredible passion for the difference we're all trying to make. So with that, here is a quick 60-second review. We'll see how well I do on time this week. So episode 27 in January 2019, we welcomed Robin Powell. And what makes Robin really interesting is that he's a journalist who discovered our shared investment philosophy and now spends an unreal amount of energy spreading that word of this philosophy. And then he combined his background in television journalism to create a simply remarkable documentary called Passive Investing: The Evidence. And in that, he interviewed people like Bogle, Ellis, Melchiel, Booth, French, Ferry, Bernstein, and Sharp. And these conversations he had with them greatly impacted Robin. So this documentary, along with a great deal of other content, you can find at sensibleinvesting.tv. In addition to that, we discuss his views on the state of financial advice around the world, including the role of robo-advisors, and how so many people think that financial advice is solely about recommending mutual funds or moving money around. And he, of course, says it's so much more than that. And he says we have a large responsibility towards client education. And also, being a journalist, Robin was able to speak about the short-term nature of daily journalism, which can cause people to lose long-term perspective. That was Robin Powell, our guest in episode 27. He also wrote a book, which is our book review this week, which will be quick because Robin Powell and his co-author, Jonathan Hollow, will join us in a couple minutes here. But the book they released is called How to Fund the Life You Want, What Everyone Needs to Know About Savings, Pensions, and Investments. So as part of our Back to Basics this year, we're featuring books and authors, if we can get them on, to talk about their book to help improve financial literacy. And this book, even though they targeted for people in the UK, the material is absolutely applicable to anyone. And so introduced Robin already. So Jonathan Hollow recently worked for the UK government's Money and Pension Service. He worked with leaders and regulators in government and the financial services industry to create the UK strategy for financial well-being. He previously worked as editor-in-chief for the Cabinet Office's online publications before becoming the innovation director at Serco, which is a UK-based global public service outsourcing company. So incredible background. This book Ben is fantastic. It's 277 pages long, and it is an incredible resource. I would suggest that you buy the hard copy. I read it on Kindle, but there's workbooks in it that don't really work that well in Kindle. So hard copy, I would say, is a must. I really like how they started the book, which is with a chapter called Your Money or Your Life. So they encourage you to think about the life you want, what's important to you, the goals that are important to you, and to realize that a happy life is made up of experiences, relationships, and time, which of course is stuff we've talked about. Aiming for money as an end goal is the wrong target. Obviously, we're in sync with them in terms of investment and planning philosophies, including things like capture market returns, manage your asset allocation, find a good advisor, and use conservative safe withdrawal rates. One part I really did like is they highlight 6 rules that one must follow to be successful. And in our conversation, Robin talked about a couple, but quickly, the 6 are: have a purpose, a plan, and a method. Take a slice out of everyone's business, own the market. Number 3, to dilute your risk, add lots of time, focus on the long term. Number 4, they call it phone a friend, especially when times are taxing. They suggest have someone, be it your advisor, your partner, or some other trusted guide to have around to keep you anchored to your plan. Number 5, focus on what you can control. These are things like savings rate, your behavior, your spending, and your asset mix. And number 6, keep your investments simple, cheap, and automated. So if you're looking for what I would call an active resource, a resource you keep on yourself, I highly recommend this book. Check it out. The workbooks are excellent. So with that, let's go to our conversation with the authors, Jonathan Hollow and Robin Powell. Jonathan and Robin, welcome to the Rational Reminder podcast.
Thank you.
Well, thank you very much for having us.
Yeah, it's great to have you back, Robin. It's super great to welcome you back. And Jonathan, great to meet you. And I must say, I was asking before we started recording, I asked Jonathan how you guys met, assuming it was a part of your career. And you guys have been friends for over 40 years.
So we have. And then we decided to write a book together.
It's strange because, we've had very different career paths. I've been a journalist, and Jonathan has worked in various communications roles, but we've both developed a sort of strong interest in financial education and helping people to do sensible things with their money.
So where did you get the energy, and what prompted you to write this book, which is an incredible feat?
Well, that's a good question because anyone who's written a book will tell you that it's not a decision you should take lightly. It's a huge undertaking, and we really wanted to do this properly. We wanted to research it thoroughly. We wanted something that was absolutely evidence-based, and so it was a huge time commitment. There are lots and lots of books out there, far too many books, let's face it, Cameron, about investing. Mm-hmm. But we just felt there was still a gap in the market for a book that was, as I say, evidence-based, but there was also accessible and written with kind of real people in mind, with real lives and hopes and aspirations and so on, and not investing nerds. So many of these books tend to be about which stocks and funds you should buy to become rich and so on, but we really didn't want that. We just wanted to help people, as the title of the book implies, to fund the lives they really want to lead.
The other thing that's clear from looking at the book is that you wanted it to be practical. I mean, there are workbooks in the book, which is not super common. How do you recommend readers get the most out of the book?
Yes, we were very excited by the idea of attaching a workbook to the book. So you can download it from Robin's evidence-based investor website, print it out and work through it alongside the book itself. And we felt this was valuable and necessary because there are just so many great tools and calculators out there on the internet that will help you with so many different aspects of your financial life and looking at your own behavioral strengths and weaknesses and so on. But we didn't want just to have a kind of index of them at the back that was a kind of complete jumble. So we put them together in a logical framework that means if you work through the workbook, you're working through the sense of each chapter of the book and trying to apply it to your own circumstances. And by the end of it, you'll have a good sense of your financial plan and where you stand, and have something really strong that you could take to a regulated financial advisor if you want to use one, and have a great conversation with them. In terms of getting the best out of the workbook, I mean, I think one thing I would say is it probably is helpful to have a physical copy of the book, because then you can scribble on each chapter as you go through it. If you're a procrastinator, it's probably a good idea to work out how long it takes to read the book, add a couple of weekends on after that, and write down a date, pre-commit, and say, by date X, I plan to have completed the workbook, having read the whole book. And then the other thing we emphasize throughout the book is the importance of talking through what you find and what you think with your partner and or with a friend. We absolutely say, don't go to your friends for investment tips, but there are plenty of really useful things you can go to your friends for, like how often do you discuss with your friends how much money you think you're going to need to live on when you stop working. That's something that everybody can discuss. There's very, very little harm that can come from that, and a lot of benefit. So we recommend that people talk through the ideas and conclusions from the workbook with somebody they trust.
Robin, I really like the 6 rules you guys highlighted, and I actually cover them in the intro to this conversation. Are there a couple of those rules that you'd really like to highlight?
Well, yeah, we really wanted to simplify this whole area of investing and personal finance, and particularly saving for retirement. Really simplify it, and we condensed it into these 6 rules, and they're all important, but 2 that particularly resonate with me. First, take a slice of everyone's business. I mean, it is just a no-brainer that if we want to provide for our long-term financial prosperity, that we need to invest in companies. Equities, historically, for well over 100 years, have produced returns that are considerably in excess of bonds, of cash, and so you really need to invest in equities. And all the talk is about, well, what sort of equities? Canadian equities, UK equities, buy them all. Right. You should really diversify across the whole world. And I see it as taking a sort of slice of global capitalism, if you like. So if you're investing in shares, you're sharing in the profits of human enterprise. If you invest in bonds, you are effectively lending human entrepreneurs money to do what they want to do, to make the world a better place, to solve the world's problems. But either way, capitalism has proved remarkably resilient. Just look at the last century and the extraordinary setbacks that investors went through, and yet if you stayed the course, as Jack Bogle liked to say, you kept your discipline, it rewarded you in the end. The other rule that I would highlight really is to focus on what you can control. And most of the things that we think are important are actually not particularly important in the long run. And almost everything about investing we cannot control. We can't control the economy. We can't control the outcome of elections and referenda and so on. But we can control how much we pay to invest each month or each quarter, each year, whatever it is. And also we can control our expenses. And as you guys both know, expenses are a really important part of this story.
Jonathan, can you describe the 8 keywords that you set out for managing money day to day?
Yeah, I certainly can. I mean, we devote a whole chapter in the book to managing money day to day because of this profound truth that when you're earning, every pound or dollar you earn has to pay not just for your current life, but some of it has got to pay for your future life. So you've got to squeeze as much as possible out of every part of your income. So we talk about the 8 words are accept, divide, track, stabilize, prioritize, trim, maximize, and teach. Now, I'm not going to go through them all one by one, but just to kind of pick out the themes in them. The first and the last, accept and teach, are really about you and your emotions and your relationship to money. You've got to accept any past mishaps or fears or mistakes you've made about money. And when you have got a system for managing your money day to day, you really should be teaching it to young people. And we may come back to that later in the conversation. And then in the middle of that, we propose a very simple system, but for some people, some readers of the book, it's still a revelation, which is set up separate bank accounts, divide your money up into separate bank accounts so that when your paycheck comes in, you've got some money going into an account for bills, some for an account for everyday spending. We recommend a separate account for holidays because a lot of people find it difficult to manage holiday spending. And then you can track the money that's going into those, and that becomes a natural budgeting system. Once you've got that natural budgeting system up and running and your money is stabilized, you've got to think about your priorities. Can you put more into your long-term savings? Can you trim your expenditure? Can you maximize what you're getting out of your savings accounts? So all these things add up to a simple system which doesn't require endless spreadsheets. It's really about setting money up into different bank accounts, drip feeding it in, and taking care that you know whether the amount you're drip feeding in matches what's going out of each of them each month.
Good advice. In the book, Robin, you guys recommended that people continually keep up their knowledge up to date about what's happening in the world of money. What's the best way for people to do that?
Well, perhaps maybe I should start this answer by reiterating something I said earlier, and that's that most of the things that we think are important, particularly as far as investing is concerned, are actually not important at all. They might seem really important in the present moment, but in the great scheme of things, they're not very important. So I think you need to think very carefully about, what information is really valuable. I like to make a distinction between business news and money, personal finance news. I mean, we have this catch-all term, financial news, which I think is too broad. Business news is really interesting in its own right. How businesses are faring in the cost of living crisis that we've got in various countries, including ours around the world, which sectors are doing well, what are the latest trends and so on. But that's what I call business news, and it's got really nothing to do with investing. And there are lots of investment writers and marketing people at fund management companies and brokers and so on who will try to turn those stories into investment stories. So, for example, I was just reading this morning a really ridiculous article about the spending trends of millennials, and how you could actually position your portfolio to kind of capitalize on those spending trends, which is complete baloney. I would differentiate between those two things. For personal finance and money news, I mean, how much is new? That, there isn't a huge amount of new stuff to say about, particularly about, how to invest, as you know. The most reliable newspaper we find, this is not a plug. I'm not paid by them to say this. Jonathan, I mentioned the FT in our book. There's another very good website, Money Saving Expert, run by a guy called Martin Lewis here in the UK. In Canada, I'm a fan of Rob Carrick in the Globe and Mail. I can't say I read that publication regularly, but most of what he writes about kind of tends to chime with me. So look for reliable media sources. The other thing I would say is a critical thing that we go to in the book is this whole idea of tax changes. Tax changes are really important wherever you are in the world, and you need to keep abreast of what's going on. What is the most tax efficient way to invest? And the rules change all the time. It's actually really quite hard for ordinary people to stay abreast of all those changes. And I would say that's actually one of the strongest arguments for using a financial advisor.
Jonathan, we talked earlier about day-to-day money management. How important do you think it is to have a regular savings habit?
Well, it's very important. In my last job, I worked for a government body called the Money and Pension Service, and we did surveys of thousands of UK adults, and we asked them questions about what they believed, what they did. We set them tests about what they understood, and we looked at details of their bank accounts with their permissions. And what came out of that was that regular saving was the kind of golden lead indicator for lots of other good money behaviors. People who saved regularly were more likely to understand money better, more likely to have a healthy bank account, and so on and so forth. But what was really interesting about it was it wasn't about the amount. Even people who were saving really tiny amounts of money on a regular basis, for them, it was still a golden indicator. So I don't think you can say that it's just because people with a surplus of money who are able to save are generally, financially well. It seemed to be more deep-rooted than that. Whether it's cause and effect was impossible to untangle with that type of survey. I mean, are people, better with money because they save, or is it the other way around? You can't be sure. My hunch, and it's only a hunch, is it's a bit of a two-way street. And, there's a sort of golden circle of behavior and reinforcement and confidence. So I would say getting into the habit of putting even a pound or $1 away a month, as long as you stick to it, is going to increase your financial confidence. Obviously, many people can save more and they should save much more, but they shouldn't feel that they need to opt out if the amounts that they can afford are really tiny.
Your comment about confidence is really interesting because, and I agree, we can't you can't find causation with that type of data, but there's a lot of other literature that you may be familiar with about financial self-efficacy and financial self-confidence, and those are related to lots of positive financial behavior. So that's a really interesting comment.
How do you guys think parents should teach kids about money?
Well, I'm afraid the first thing is they shouldn't rely on schools. Um, we did, again, with the job I worked in, we did a lot of research into what was going on in schools in the UK, but I was also part of an international network that was looking at best practice across the world. And a lot of schools don't teach financial education. And with the ones that do, what you've got to remember is teachers are human. And a lot of adults aren't financially literate and aren't financially confident. So that is probably going to seep out of the teachers who are actively teaching financial education, but who are, not so confident or self-aware themselves. So it really is much more valuable done at home. I think one thing I would say is think of the age at which you should start talking to your child about money, then halve it. Because most people start far too late, and a lot of really important money attitudes and behaviors are formed at an incredibly early age. So, beginning to talk to your child about money at the age of 5 or 6 is not too early. And even before that, impulse control and self-control is such an important part of the way we manage money in later life. So there are things that happen even before that influence things. In terms of what the evidence showed about what parents should actually do, basically, there are 3 golden experiences at home that if the children were exposed to them, they were generally going to do better with money in later life. The first one was seeing and handling money from an early age. And don't forget how difficult that is in an age of digital cash.
Yes.
Talking about money in the home, what it's worth, what it's used for, how to manage it. And then the third one was that the children who did well received money regularly and took responsibility for it. Now, with that last one, it could be pocket money, or it could just be delegating an area of the household budget to a child and saying, well, we need to get bread every week, we need to get milk every week. How about if I give you this amount of money, you can take responsibility for that? So pocket money is part of that picture, but there are other ways of approaching that as well.
If I could just add to that, what an amazing opportunity the current economic and global situation presents us with as far as educating children about money is concerned. I know the situation's similar in Canada. Here in the UK, we've had soaring inflation, higher inflation than pretty much anywhere in Europe, really, and prices in particular going up. It's still a question about whether we're going to see a recession and redundancies and so on. But people are already starting to lose their jobs, and these are all really kind of difficult issues that Brits, particularly, reserve Brits, don't particularly like talking about. But they are really important to talk about. And now is a really good time, I would say, to engage children about the value of money, the importance of work, the fact that we can't always rely on work, and we have to keep building our skills and employability throughout our lives, because that's, at the end of the day, our human capital is our most valuable asset of all. And just encouraging children as well to think about spending. Money doesn't grow on trees, and we need to spend wisely. And yes, we need to treat ourselves, but we also need to have savings and investments. And we also need to set aside money as well for helping others less fortunate than ourselves. So it's a really, really good learning opportunity, I think.
Jonathan, something that we've talked about in a few recent episodes is that financial advice theoretically has benefits, but the financial services industry has a lot of really big problems that make it a bit of a minefield for investors. How would you suggest someone go about finding what you call a first-rate advisor?
So we made that the last chapter of our book because we wanted people to be as educated and self-aware as possible before they started to look for a financial advisor. Because really, the first thing you need to do is think about, well, what are my needs? I mean, Robin mentioned the importance of being up to date with tax advice. In the UK, being qualified as a tax advisor is a different skill from being a financial advisor, and they may overlap in the same person, or they may not. So you've got to think about the kind of needs you have. Obviously, in different countries, there are different regulations and there are different kind of directories. But at the end of the day, you're going to come up with a short list of people that you think might be the right person for you. One thing I would say is in this age, here we are talking on Zoom, you can have a perfectly good financial advice consultation over Zoom. So the world is your oyster, or your country is your oyster. Don't just look about for people that you might be able to meet locally. And then the other thing we suggest people do in our last chapter of our book is that they prepare what we call a death box. And I got this expression from a very good financial advisor I used in the UK. And it's an index of your bank accounts, a state of the nation about all your money, your savings, your pensions. This is what our workbook helps people to put together. But the reason why that's so great to have before you go to see a financial advisor is, firstly, they're going to know that they're not going to have to put that together themselves and spend hours and hours sort of scraping people's money information together. And then the second thing is, in that first meeting with them, because most of them will offer you, say, an hour's first contact for free, you can see whether they come up with some really brilliant ideas about your money circumstances. And they can't do that unless they've got your state of affairs in front of them in a really neat, indexed way. Now, the reason why we call it a death box is because when you do eventually die, the people left behind will find it incredibly useful as well. And most people don't do it, or if they do, they do it a long time after they should have done. So we're very keen on encouraging people to think about that in terms of getting their affairs in order.
I can't emphasize enough the importance of going to your prospective financial advisor who you're interviewing with a list, a comprehensive list of questions, and you really are listening hard. You can record the interview on your phone if they're happy with that, or certainly take notes. And if you're not happy with any of the answers, then you should be very skeptical about using them. What professional qualifications have you got, Mr. Advisor? What qualifications do you have over and above the minimum requirement? Financial regulators around the world actually set a very low bar for becoming a financial advisor. So what have you done over and above the bare minimum? Here in the UK, we talk about restricted advice and independent advice, and restricted advice is absolutely worth avoiding. It is essentially sales. What you're looking for is an independent advisor who has the whole cross section of investment products and so on to choose from. What is your charging model? Do you charge so-called ad valorem fees, percentage fees, or do you charge an hourly fee, or do you charge a fixed fee? There's no right or wrong way to charge, but there are certainly advisors out there who are charging far too much money. Generally speaking, paying by the hour, not many advisors will let you do that, but generally that's the most cost efficient way to go about it. There's also fixed fees, which again, particularly those with larger portfolios, can work out considerably cheaper. How much would I pay for your advice on an ongoing basis? That's another critical question. Also, just find out something about their investment philosophy. If the advisor is talking about the markets and his opinions on, what's going to happen to UK shares or Canadian stocks or whatever, avoid, because nobody knows what's going to happen to those things. You really want to find out that this person knows about what Jonathan and I call evidence-based investing, that they know the shortcomings of active fund management. They know the importance of broad diversification and focusing on the long term. So those are really the key questions I suggest that everyone asks an advisor.
I think it's safe to say that advisors will not like the last chapter of our book, because we set out these kinds of questions. They are harsh but fair questions, but they will ruthlessly whittle down your shortlist quite quickly to the really good ones. And that's why we say, if you're going to pay for it, make sure they're first rate.
The part that I liked about that chapter is you also asked or proposed some more provocative questions. Like, what is the latest evidence on the merits of active and passive? Fine. Then what other new evidence should I be aware of? Are there recent innovations that can help me manage my money better? What mistakes have you made recently? Like, these are provocative questions, I think, to tease out, more of the character perhaps of the advisor. How is the financial advice profession changing? I mean, this is something that has been alluded to. We've talked about a lot on this podcast, but these are more, I think, thought-provoking, provocative questions that someone can ask.
Exactly. And we use this metaphor in the book of saying your financial advisor is a kind of financial bodyguard. They're there to complement you. So if you have particular weaknesses in your ways of managing money, you need an advisor who doesn't have those same weaknesses. So you really do have to get to know their personality and try to predict their behavior.
At the end of the day, of course, it's all about trust. And there are two components to that. One is getting satisfactory answers to the questions that I just suggested people ask. But the second thing is just it's a gut reaction to that other person. You know, can I really trust this person? Yep. Does he really get me? And Cameron, that's such an important point that you make about the changing nature of financial advice. It is not about investment advice anymore. Investing, of course, it's important, but it's a small part. It's a relatively small part of a much bigger picture. The most important thing is that you feel that this person is listening to you, is understanding what you're saying, will want to, learn more about you and have an ongoing relationship with you and helping you on your investment journey. And at the end of the day, that's such a subjective thing. Only you can say, having spoken to someone for an hour, if you really entrust that person with your wealth and your financial future.
Such a great point to wrap this up. Jonathan, Robin, again, congratulations on the wonderful book, and thanks so much for joining us.
It's been a pleasure.
Thank you very much.
Thanks, guys.
Thanks again to Robin and Jonathan for joining us. I thought that was pretty fun. It's also kind of fun that they've been friends for 41 years, which is crazy. It goes back to like teenagers.
Yeah, you can kind of tell.
Yeah, I thought they were colleagues that met, in the biz, so to speak. But no, they've been longtime friends and thought it was time to write a book. Yeah, no, it's nice. You can tell they're buddies just from the way that they, I don't know, you can just tell. I know I keep mentioning this show, but Succession as a show is phenomenal. Like every week, we can't wait for the new episode to come out. You've been watching any shows recently?
Nope.
Yeah, I think now that summer's coming, there's going to be less television, which is not a bad thing. I wanted to share with everyone that our friend and a fellow financial advisor, Jeff Bernier, invited me on his podcast a couple of weeks ago, and it was super fun. His podcast is called The Money and Meaning Show. Jeff's an advisor in Atlanta, and a really, really nice and really thoughtful guy, and his pod is definitely worth checking out if you're interested. And you and I, Ben, are going on for the first time together on someone else's pod in a couple of weeks. Fellow Canadian Sean Maslick, who is a financial wellness advocate, has invited us on his popular podcast, The Most Hated F Word. So that should be fun.
I agree. I think it should be fun.
the tables turned on us.
Mm-hmm.
You wanted to talk about CE credits.
Oh, yeah. So we talked a while ago about how we were working on a project where we would turn Rash Reminder episodes into continuing education courses that financial advisors can take. We have completed 10 episodes as fully accredited CE credits, both for IROC and FP Canada, or it's not IROC anymore. The new self-regulatory organization, CIRO, right?
CIRO,
Yeah.
CIRO.
So been accredited by them and by FP Canada. They're priced for people who need CE credits. Like if you're a casual user, it's probably too expensive. We ideally will make a product for casual users too, but right now it's just CE credits, which are more expensive because we have to pay a bunch of fees to get them accredited. So we want to at least recover our costs on that. So we're pricing it right now at $150 for the full package of 10 episodes. One of those episodes is worth 2 credits. So I mean, when you look at the price of CE credits out there, it's not a bad price at all.
I think I have to do the course. We don't get credits for doing the production of this.
Yeah, no, we don't get CE credits for.
We have to go take our own exams.
Correct. We have to go take the CE credits ourselves. Yeah, but for IROC, as any IROC advisor knows, it's we're coming to the end of a 2-year cycle this year. So there are 11 credits available in there. And one of them is an FP Canada professional responsibility credit and an IROC compliance credit, which on both sides, so those are the harder ones to get. So our episode with Harold Geller met the accreditation bar for those types of credits there. Anyway, the courses are great. The questions are really good. Ray on our team here created the questions, and I think he did a great job. The interface is nice. Yeah, so we'll put the link in the show notes, but it's just learn.rationalreminder.ca, and you can see the product there. And I didn't mention that for the $150, it's the existing episodes that are in there now, plus any additional episodes that we create between now and well, it's a year subscription for $150. And we're going to release this. We're going to say this on this episode and see what happens. And if, nobody signs up, then we're probably not going to do any more accreditations because we have to pay for them, like I mentioned earlier, for the accreditation process. But if enough people sign up, and I don't exactly know what enough is, then we'll continue. We'll get back on creating additional courses. So it's a test. It's an experiment. We'll see what happens. But it's out there now. And we hope people subscribe because it's, nice. I think it is a nice, useful product, but we'll see. We'll see what happens.
I had some good people reach out to me. Benjamin reached out to me from Kitchener on LinkedIn. He has a book coming out this summer on cognitive and behavioral biases and how they affect long-term investing. So he's going to send us an advanced copy, and hopefully it's great, and love to have him on as a fellow Canadian and an author, which is nice. And on Twitter, we heard from Michael, who's got a PhD in Stoicism. And after listening to our conversation and book review with Lucas 2 weeks ago on the book, The Obstacle is the Way, he reached out offering to be a guest. So hope to have him on sometime as well this summer. So it's really cool to hear from listeners that are engaged and have something interesting to join us about.
Definitely.
Meetups coming up, LA, September 9th, Future Proof Conference in the fall. If you're going, let us know. And we're hosting a breakfast. Toronto meetup September 20th. Edmonton for the IAFP conference. Our friend Marcus offered to help set something up. So if you're going to that, drop us a note for any one of those events at info@rationalreminder.ca. Unreal guests coming up, Ben. We have Burt Melkiel next week, David Blanchett in 3 weeks, Mayor Statman in 5 weeks. We have authors Nick Majuli and Jill Schlesinger coming up. Incredible lineup of guests. I mean, we've already recorded Burt Melkiel and David Blanchett. Incredible conversations.
Yeah, those were incredible. And we have the fun task now of probably later today after we record this, we're going to map out guests for the rest of the year. So that should be fun. And I know we've already got some very interesting names in mind.
Exactly. As always, reach out to us. We're on Twitter, LinkedIn. We're on Instagram. Companies on Instagram as well. Anything else, Ben?
No, I think that's good.
Something we should highlight is the webinars that the team's been doing. So we've been doing a lot of live events lately, and they're going to be posted on the PWL Capital YouTube site. So I see the first one's already been posted there that they did. I mean, it's Canadian-centric on some tax updates, but that was a couple of weeks ago. It's there, but more of these events will be showing up. So go and hit subscribe on our YouTube channel.
Yeah, and we'll announce any future webinars. That the timing hasn't lined up where we were able to mention them on an episode before they happen, but for future webinars that we're planning on doing, we'll mention them here on the podcast and people can check them out. But the ones that we've done that, like you said, we'll post recordings of, they've been great.
Yeah, and if you follow us on Twitter, or LinkedIn, we'll repost everything that comes up. And then the team's really got a format down where it's an active, dynamic Q&A type format for a lot of these, and they love doing it. And the engagement, there was one last night that the engagement I heard was fantastic. You get into a groove and you just prompt questions using a tool they have in this presentation software. So
very cool.
Anything else this week?
I don't think so. I think we're good. Hopefully the covered calls topic was interesting. If people thought it was or wasn't, let us know in the YouTube comments or in the Rash Reminder community. It's always great to hear from people about what they thought about the episode, because that's something that we don't always get, and then we don't know. Was it good? Did people comment because it was? Did people not comment because it was bad, or because it was good, or because it was mediocre? We just never know. So we always appreciate comments about the content, whether it was good or what resonated or what didn't.
Yep. Beautiful. All right. Thanks everybody for listening, and we'll see you next week.